and I'm going to present my stock this evening, and my stock is in the consumer discretionary sector, and it's a specialty retailer, and it's TJX Corporation. TJX is probably best known for a series of stores throughout the country. If you'll notice, their largest holding in their portfolio of businesses, they refer to as Marmax. That's actually a combination of the words Marshalls and TJ Maxx. And Marshalls and TJ Maxx, as you see down in the footnote down here, are two of the branded stores that are in the TJX portfolio of businesses. In the U.S., we also have Home Goods, one of my wife's and my most favorite stores, and A.J. Wright, which doesn't happen to be in our particular geographic area, but some of you might be a little bit familiar with. I noticed that of the $20 billion in sales, about 3/4 of that is occurring in the United States, and the rest of it in Canada and in Europe, and obviously different brand names in Canada, and then again different brand names in Europe. I'm fascinated by the definition of off-price retailing from TJX's point of view. And TJX goes after a different customer than the typical off-price retailer goes after. We think normally of off-price retailers as stores like Walmart or Dollar General or Family Dollar or Target, and they attract a certain clientele. TJX makes no bones about it. They're going after women in the 35 to 55 age bracket, and they're going after women that have upper middle class incomes. And they're doing that by putting brand name merchandise into their stores and then discounting it a lot so that people will buy it. Their commercials on TV describe exactly how they go about picking up the buys that they put in the stores. They swoop in when designers make mistakes. They buy overruns from fashion houses that perhaps have not gauge the market correctly. So they believe in opportunistic buying, and then they believe in changing that store on a really rapid basis so that even if you were to visit the store every single week, you'd have a different shopping experience, that the assortment of goods would be different. And they handle that by really aggressively managing their inventory and trying to keep costs as low as they possibly can keep them. I was very interested in this little graph right here, which showed me what happened to same-store sales in this company during times of recession. And the recessions are in these little gray dots. And you'll notice that during times of recession, the TJX stores actually did as well as they had in similar years on either side of the recession, or in some cases they did considerably better than they had in similar years. In 2010, for example, same-store sales right now are increasing at about 6%. That's a pretty decent increase when you notice that in the last 7 or 8 years, the average has been somewhere in the 1%, 2%, 3% range. Here's my graph on TJX company, up, straight, and parallel. You folks from mid-Michigan understand what I'm saying when I say that. And I've taken advantage of Toolkit's ability to add the analyst projections for sales and for earnings, and they certainly tend to move along the lines that I've projected growth going out at. I've projected growth in the future at 8.5% on sales and 10% on earnings per share. The analysts themselves, the ACE number, is at 12%, and the implied growth rate is at a phenomenal 35%. I'm not sure that I believe that implied growth rate number. It's a huge number, but it's there for you to take a look at. I've also, excuse me, I've also taken advantage of Toolkit 6's ability to graph a couple of other metrics on the same graph as the 3 lines that we're used to seeing, and I chose to put shares outstanding. I like to see when a company is continually reducing shares, and I also put dividends. I also like to see when a company has a nice consistent growth in dividends. So I think those are both really, really interesting metrics for me to explore. I like to click on cash flow also and make sure that cash flow follows as closely as it can the earnings line. It's the ability to play with earnings sometimes is there with the auditors, but it's much harder to play with cash and to play very much with it. So if cash flow matches the earnings line, that's a pretty good thing in my estimation. I'm looking at the back and I'm noticing pretty decent profit margins for a discounter. I'm noticing phenomenal return on equity numbers up in the 40s and 50s, and the most recent year is higher than the 5-year average. It also appears that TJX has a handle on its debt at the moment, and the debt is under the number that we would consider acceptable, which is around 33% for a typical company. Here's section 3 on the SSG, and I look at the downward trends in both of these numbers here, but I also ask myself what contributed to these downward trends. I noticed that in the middle we kind of stabilized, and there was some stabilization going on right here, and I'm not so sure that as we move forward 2009 is not going to be an outlier of some sort. So I chose to take these averages of 17.6 and 11.6 and actually use them on my SSG. I don't do that very often, but I did in this case choose just to use the averages. I felt that they were fair as far as the company is concerned. I did adjust the most recent 4 quarters earnings, and I came up with a low price that I used of $38. Gives me a fairly robust upside downside, maybe on the cusp of being a little tiny bit questionable, but I think the company is really undervalued at this point. And I'm looking at a par value for my SSG of 13.7, comparing it to a par value coming from Manifest Investing of around 15%. Those are close enough for, in my mind, that I like the fact that I am that close in my value, and I think it's a good, solid addition to our portfolio. So I'll turn the screen back over to Mark now. Mark, you're the new presenter again.
All right, come back. Okay, Hugh, are you out there? Uh-oh.
Yep, I'm here. Can you hear me?
Okay, do you want me to man the slides for you? Do you want me to switch the mouse to you?
No, if you could man them, that would be good, because...
Let me blow that up a little bit. Whoops.
We've had a couple of glitches tonight.
Yeah, in fact, we should warn everybody that we have thunderstorms in the Midwest that place us all at risk tonight. So, all right, go ahead, sir. And I do have your PDF available if you want to leaf through that. So, either way.
Hold on till I find it again. I keep forgetting that it's a black screen when I have to flip through. So, the company I picked is Costco. It's a company that I've been looking at actually for a few months now and have been buying it reasonably regularly. I know the price really has appreciated by a reasonable amount in the last couple of weeks, but I still like it. And I like it because even though the price is approaching a high, it's still not, I think, where it should be if you look at its growth trend over the last 5 years. And the other thing I like about this company particularly is that its margins, they're low. Its EBITDA percent EBITDA is on sales is low compared to the industry, but it's something that will grow. Now, take a peek at the SSG here, and as you can see, yeah, it's not perfect, but it's not bad either. I think when you do an R-squared on this to see how parallel those lines are one to the other, it's about 99%, but it's not as pretty as the one we just looked at. And you can see that there was a downturn in 2008, 2009, and in fact, if you look at the profit margins for the company in that period as well, they took a real hit. There's another company that I actually look at. I suppose you would call it a competitor. I would define a competitor as obviously somebody who's fighting for the same dollars, and in that case, clearly Sam's Club, Walmart is a competitor, but also companies like Target or even Walgreens would be competitors as well in certain areas. Well, there is a company that I always look at, which is called Casey's General Stores. I don't know if people are familiar with that one. It's a Midwestern company.
The Midwest, yeah.
Yeah, CASY. It always has a reasonably nice looking SSG, but it always seemed to be super highly priced. And I was looking at it earlier in the year, always wanted to present that one, but the price just always leaps up. Let's move on to part 2 of the SSG. You can see there the pre-tax profit margin has declined. 2.4 compared to 3.0, which was in 2005, is a big drop. But it is improving, and that's the take-home lesson. I think that there's substantial profit margin growth in the offing for Costco next year. It only opened 2 stores this year. It still had top-line growth on its existing store. It has 70% renewal rate for its membership. It has an increase in its membership base. It will open more stores next year in both the U.S. and overseas, and I think there is growth in the offing for this company. And you can see that its EBIT it's okay. I mean, it has dropped. It's at almost the lowest point it has been in the last 10 years. Excuse me, its return on equity, 2B, but it has growth to grow. As I said, now when you look at its competitors in the industry, and you're kind of generous, at least I am, as to who I would assign as a competitor, it's down at the bottom in terms of profit margin, but it's a well-managed, well-run company, and that is going to be fixed. Again, if we go to scroll down to parts 3 and part 4, I was actually happy with the PE ratios that the stock selection guide gave me. They've been pretty stable for the last couple of years, but just looking at its current earnings, its projected earnings, the PE ratio, and the PE ratio is the average of the last 5 years, the upside down ratio, 4-to-1, puts it in a buy zone based on today's price, even though that price is pretty high. And when you look at manifest investing, its projected, its par, is only about 10%. Not super, but again, I think there are other things in the offing here for this company. And of course, the company has a dividend, and it's a dividend that should continue to grow. Takes a chunk of its earnings or income and pays it out in dividends, and as the company grows its sales, company grows its profit, dividend will grow along with that. But overall, it's a good company. I like its honesty. I like its forthright. I like the way it does business. I like the simplicity of its model. It differentiates itself well in that space. And fingers crossed, as I said, I have been buying Costco for the last couple of months, and I do expect it to more than double within the next 5 years.
Hugh, we have a question. Bill, I'm going to unmute you. Bill Thompson, you're unmuted. Go ahead and ask Hugh your question.
Oh, that's an easy question to answer.
Bill Thompson? Well, Bill's having some audio problems. That's all we have right now.
Okay, well, thanks, Hugh. And I have to agree. I think I was kind of shocked that they had that decline in profit margin, and I have to share your conviction that I think they're headed back up and should improve here shortly. So
customers keep coming through the door.
It's a fascinating store. It's one of the few stores I actually even go into.
Yeah, exactly. That's what I do.
Willingly. You know, usually it's Mark's leaving the trail as he drags his heels in the parking lot, but that one's pretty cool. All right,
Mark, we're getting some questions, Mark, from some of our people that are using Yahoo the same way that we use Yahoo in Manifest, and they're wondering about all of the NAs right now that are listed in the earnings for the analyst estimates. Can you speak to that just a little bit, Mark?
Yeah, I can, and Ken, I know you've experienced this too. As we take a look at those, I think what we're seeing is a whole bunch of analysts out there recasting their estimates. And whatever their process is for tracking that, probably the best way to characterize it is to say there's clearly a disturbance in the force. It really comes down to there is a disturbance, and we've seen this happen in the past, not quite as heavy as it has been lately, but when there is a little bit of turbulence, a lot of times what happens is they default to NA for a while, and they generally in the past have repaired themselves in a few hours. Now we're seeing it last a few days. In fact, I think my slide's got NAs on it when we get to it here in a few minutes. Passes here pretty soon.
Or
all right,
whoever's next.
Let's switch to that southern gentleman in Utah.